Before you buy or sell a single ounce of silver today, you must watch this entire video because what happened overnight changed absolutely everything. Gold crashed to $4,557, silver collapsed to $78, and Bitcoin broke below $80,000 to hit $74,532 in brutal fashion. This is no longer a normal correction. This is a full liquidity crisis, and today I will show you the document that caused it. But before we expose the CME, I need to know who is still standing because the comments today will be extremely active. Comment right now where you're watching from and what time it is there. Let's show this community is global and awake. Pause the video, comment your location, and let's move directly into the evidence mainstream media refuses to discuss. Last Friday, we witnessed the worst single-day collapse in precious metal since 1980. With gold falling violently from record levels. Silver crashed 27%, plunging from $121 to $85 in a single devastating trading session. We believed the damage was done and that the Kevin Warsh nomination had already delivered its shock to markets. We expected a recovery, but we were completely wrong because the second phase began while most of you were sleeping. Sunday night, gold smashed through critical support at $4,600 and collapsed to an intraday low of $4,557. Silver, already wounded, lost another 12%, falling from $80,000 down to test the 78 level. Some physical market bids were reported as low as $71 during the height of Sunday night panic. Bitcoin, the so-called digital gold, collapsed to a 9-month low, proving nothing was immune to liquidation. This was not ordinary weakness. This was forced liquidation driven by a coordinated and highly calculated takedown. The smoking gun was a 36% margin hike announced by the CME on Saturday night. It was released while markets were closed and traders had absolutely no ability to react. At exactly 5 p.m. Eastern on Saturday, the CME issued new margin requirements effective after Monday's close. They waited until the most volatile week in precious metals history had ended before making their move. The timing ensured mass liquidations before traders could raise collateral or reposition portfolios. Silver margin requirements jumped from 11% to 15% in a single stroke. High-risk accounts were hit just as hard, with margins increasing from 12.1% to 16.5%. Gold margins rose as well, increasing more than 33% across all risk categories. A single silver futures contract controls 5,000 ounces, worth $425,000 at Friday's close. Before the hike, you needed $46,750 per contract. After the hike, that requirement jumped to $63,750 per contract immediately. Holding 10 contracts meant an instant margin call of $170,000 in cash. Over a weekend, with banks closed, that money was impossible for most traders to raise. The only option was forced selling at any available price. That price became $78 for silver and $4,557 for gold. The CME called this risk management, but nothing about this was normal or coincidental. Normal reviews do not follow the worst crash since 1980 or occur on Saturday nights. This was a coordinated purge of leverage longs just like 1980 and 2011. In 1980, Rule 7 eliminated leverage and destroyed the Hunt brothers' silver positions. Silver collapsed from $48 to under $11 within months, triggering Silver Thursday. In 2011, 5 margin hikes in 9 days caused silver to crash nearly 50%. In 2026, the pattern has repeated with terrifying precision. While U.S. traders slept, Asian markets opened into absolute financial chaos. Japan, Hong Kong, South Korea, and China all suffered sharp declines and panic signals. South Korea triggered emergency circuit breakers after a 5% plunge in under 1 minute. Institutions dumped billions while retail investors attempted to buy the dip. China's manufacturing PMI fell below 50, signaling economic contraction. The true accelerant was the violent unwind of the Japanese yen carry trade. Trillions in leveraged positions began collapsing as the yen moved sharply. When the yen strengthens, investors must liquidate assets to repay yen-denominated debt. That meant selling gold, silver equities, and cryptocurrencies simultaneously. Over $1.7 billion in crypto liquidations occurred within 24 hours. Shockingly, tokenized silver liquidations exceeded Bitcoin's losses. This confirms institutional deleveraging, not retail panic. While you were forced to sell, someone else was quietly accumulating physical metal. That dominant name in delivery reports was JP Morgan. On the crash day, JP Morgan was involved in 633 delivery notices. That represents over 3.17 million ounces absorbed during the worst day since 1980. In early January alone, more than 33 million ounces exited COMEX vaults. The physical market never collapsed, only the paper price did. Exchange for physical premiums remain elevated, signaling real-world scarcity. Traders are rolling contracts backward to secure immediate delivery, which is extremely unusual. That behavior screams urgency for physical metal now, not later. Technically, the damage is severe, but this does not end the bull market. Gold broke key support, triggering algorithmic selling and cascading stop losses. Silver lost over 40% from its highs in just 72 hours. Critical silver support lies between $70 and $71. If that level fails, the next target becomes the 65 to 70 zone. This structure suggests a double bottom, not a terminal collapse. A V-shaped recovery is unlikely. Consolidation will take weeks. Any rallies will be aggressively sold by trapped traders seeking break-even exits. This was a historic transfer of wealth from retail traders to institutions. Margins destroyed leverage, not fundamentals. Silver remains in a structural supply deficit for the 6th consecutive year. Industrial demand continues rising through solar, electronics, and electric vehicles. Central banks are still accumulating gold and diversifying away from the dollar. Massive fiscal deficits will eventually force easier monetary policy. None of those fundamentals changed during this crash. What changed was who could survive the liquidity shock. Leverage amplifies gains, but it also accelerates destruction. Physical metal cannot be margin called or forcibly liquidated. That is the core difference between paper and reality. A true bear market requires silver below 60 and gold below long-term trend support. Those levels have not yet been broken. This is not the end. It is a violent reset. History shows the next move after forced liquidations is explosive. They can manipulate paper prices, but they cannot create physical metal. That is the absolute limit of their power. Now the question is how you respond to this information. Will you wait for lower levels or begin strategic accumulation? Comment your price targets below and engage with this community. This channel exposes mechanisms, not fear. You're not alone. Thousands see the same pattern. Share this video with anyone holding precious metals who needs the truth. This is Gray Ledger, and we will continue documenting every move and every attempt at control.